Today is Monday. It's 2:58 p.m. It's May 26th. There's a statement called a random walk down Wall Street. Now, why would people call something why would people call it a random walk down Wall Street? And especially the word random is used. So I liken my experience, although I'm not fully profitable yet, but I understand what random means. Random means that whatever situation is has disorder. Okay, there is no order to a particular uh, situation. Okay, whatever situation there is disorder. There isn't a way to categorize. There isn't a way to categorize and create a subject to define what is in front. Okay, that's random. That means that what the situation is, I am unable to predict with a uh, probability, with a threshold of probability that has a predictable characteristics, and that's what random is. So when I first started on this journey to becoming a profitable day trader, it was truly a random event. Uh, there were times when I was involved in essentially options trading, essentially buying options, uh, slightly in the money or out of the money, and then I would attempt to steer my thesis in the direction of the market. But when the market was randomly moving in my direction, I would reap the benefit of my thesis. But because of the randomness of the market, there would be times where I would be gaining, and then there would be times where I'd be losing. And ultimately, what happens is that I would be losing because of the randomness of the market. That's the definition of random, and that's a random walk down Wall Street. That's what it is. Then I realized that there are certain situations occur. Fundamentally speaking, I mean going to the basics of getting to the basics of describing what in terms of price action, the market displays a specific behavior that is beyond the threshold of being categorized as random. As a candle that has a very narrow body, okay? That in itself is not a random event. It is saying to me that there is indecision. The market is saying that there's indecision. That is not random. It is being categorized as a specific event where a change in its momentum will occur with a pause. It is a pause in price action. And that categorization of that event is freeing itself from being labeled as random. Okay? And then what happens is sometimes price will hit the bottom, hit the support, bounce up, and then hit the support again, bounce up, support again, and move sideways. Now that is categorizing a specific point in price that is not random. Something above that specific area has a specific label, which is called support. And that support has a statistical probability assigned to that price at each moment of when the candles are being printed. anywhere between support and resistance, there will be some randomness as it moves in one direction, pulls back, moves up into the direction, and who knows when it's going to reach that point. But there is a specific relationship between the support and resistance. And support is not a random event. It is a specifically identifiable, specifically assigned a statistical probability to that event. Okay? And so it is more than just a random event. Okay? And now I see why on my journey as a day trader 4 to 5 years ago, and prior to that, when I learned about the existence of the market, okay, I finally realized that the events that are occurring was random initially because I was unable to see. I was unable to see the order. There's a specific order and reasoning behind certain events. For instance, when the earnings are good, then generally speaking, the price will increase based on the newfound information. That is not random. It is a specific event assigned to a specific price action, and that is freeing itself from being labeled as a random event. Then there are things in technical analysis. That was the fundamental analysis. Now there is some technical analysis that specifically takes that price action of that single candle and add it together with another candle, and that sequence of events will cause a divergence from being labeled as a random event to something called a A plus setup. Now these A plus setups do occur. Okay, these A plus setups do occur, which means at specific moments in price action, that A plus setup is labeled to have a higher probability of a certain price action occurring at a specific time frame. And that is not a random walk down Wall Street. It is a uh, it is a statistically probable walk down Wall Street. And it took me 4 to 5 years to come to that conclusion.